a little bit mixed, not really moving in any clear direction, I think, ever since the OPEC Plus, although we've had some ups and downs. Let's kick off with our regular commentator out of Singapore, Vandana Hari, founder and CEO of Vanda Insights. Vandana, what are your thoughts on the market direction? I see you posted your Vanda Insights today, bulls and bears. I think they're kind of in a battle at the moment.
Yeah, good morning to you, Sean, and everyone else who's joined us today. So the bulls and bears, we'll probably get into that in a little bit because that's a slightly longer term view. I think what's happening right now in the markets, as you said, markets have, crude prices have been moving up since this morning. In reaction, I believe, mostly to the API report, which showed substantial and greater than expected drawdowns in US stocks across crude as well as the distillate and gasoline inventories, and nearly 13 million barrels, which is about roughly double of what analysts had expected. So that seems to be a bit of a tailwind. I think, however, not much activity after having covered a little bit, gapped up a little bit, because I think the markets will be waiting to see what the EIA report shows, not just on stocks, but I think US demand trajectory. I think that continues to be very important focus for the market. And of course, we have the Fed meeting, and whatever good or nasty surprises come out of that, I think that could indirectly affect general risk appetite in the investment community and impact oil as well.
Matt Stanley, Director of Star Fuels, sitting in Dubai. Matt, your thoughts on this market, the theme, if you like, that I'm sort of pushing, that since the OPEC Plus decision, the market hasn't really found a new concrete direction. It seems settled in the sort of low, mid, climbing back to that mid-70 number, but there's no real breakout from the OPEC Plus meeting. Even the big number of inventories, nothing seems to shift it at the moment.
Morning, Sean. I mean, look, it's 75 seems to be the summer holiday handle that no one wants to give up on. Volumes have been low in the morning, and there's been a couple of instances where we've seen the market drop off only for London to get in and bid it back up. But I mean, the one thing that I've been keeping my eye on recently has been the spread between Brent and WTI, which has gone from just below $2 a barrel. And I remember you talking on it on the show you had maybe a couple of weeks ago. And it's closer to -3 now. So I think the market is concerned that there's two things. I agree with you. There is not enough oil that is being supplied in the market at the moment to keep up with forecasted demand. Now, I mentioned in my commentary yesterday, if there's not enough of something to go around, then the price of that very thing should go up. It should be more towards the sort of $80, $85 per barrel, as Goldman Sachs like to say. But I think if I'm reflecting into the current market situation where the Brent-TI spread is, I think the market is now pricing in that there will be more US crude oil back into the market. And the bellwether for demand, apparently on a global basis, has been what the US are doing and how well they're coming out of COVID and the situation. And the irony is, yesterday, I mean, I sent my commentary before I watched the show yesterday, and I'd started about the fracturing of vaccination rollouts. You touched on it yesterday as well. And then the IMF touched on it last night. There can't be a global recovery in demand if the world is fractured and how we come out and how the vaccination rollout programs are actioned. So the hesitancy in the market, $75 a barrel is a great place to dance around. Markets, OPEC are not going to be concerned about that. The inflation argument obviously is raised the higher the end user prices get. I mean, that's all eyes on the Fed. Later on, what happens there, the IMF touched on it yesterday, the higher that inflation gets or becomes, then, the more that monetary policy is going to have to be reviewed. That we'll have to see. Brent doesn't really know what to do. $75 a barrel is like when you lose your mum on a beach holiday and you just cling onto her knee. That's what the Brent market is doing at the moment.
Well, let's go to China, because inevitably it seems to me that the dampening, if you like, of not allowing this market to move on the relatively bullish output from the OPEC Plus agreement, 400,000 barrels a day, was always seen to be below the meeting of the second half demand. And yet that hasn't really moved the market beyond this handle. I think China remains a question mark in terms of its import levels and what that's going to look like. And the sort of growing expectation is weaker than it was. Victor Yang, senior editor at JLC Network Technology. Your thoughts, Victor, on China's outlook for the second half of this year to sustain its import levels earlier seen or to drop off? Your thoughts?
Yes. Well, yes, actually, there indeed quite a lot of uncertainty as well. Also for the second half of the year, say, including more rain in some regions. Well, they say that just a few days ago, we had a terrible flood in Henan province. Well, I'm sure you have heard about that. And we
closed down a lot of ports around Shanghai, right?
Yes, yes. Well, and I'm sure you heard about it. And there will be more. Well, there will be more in the rest of the summer. So we are going to face quite a serious situation in fighting the floods. Well, so that will kind of make some impact on the country's economy too. And another factor is that the resurgence of the virus from time to time. Say just a few days ago, we had some new cases in East China, Nanjing, and from the airport. So it's quite a serious case in China when we had a few dozens of cases a day. Because it's quite different from between mostly Asian countries and the rest of the world. Say in China and some other Asian countries, if we had a few cases a day, they would be taking it very seriously and say lockdowns in some areas, and test for all the cities in China too. Say like in Nanjing, when a place has a few cases, all the city populations are tested, and for more than once, several times. Say last time in Guangzhou, we had 5 to 6 times rounds of test, and me had 5 tests in Guangzhou last time. So it's different. Say we had 10 cases a day. We had this mass test, and ports were selling in Shenzhen, which is very important for exports. Say we're closed for days. So it's quite different. This kind of imbalance would be possible. Say like in the West, when they have so many cases, they do not take it the way we do.
Yeah, well, we saw in the UK last week. I can't remember the latest phrase that Boris Johnson used. I think it was Freedom Day, that opening up the whole British economy and society in the face of, I think at the time, 50,000 infections daily, and it got quite high again. And yes, there's a much higher tolerance in the West now because of the vaccination combination, but China doesn't seem to have that.
No, they do not. And so for the second half of the year, so this will be some uncertainties. And meanwhile, we are expecting some kind of policy support from the central government later this year. Say, usually they will have kind of policy to boost the economy, say, after the middle of the year. And for this year, say, as the government has set a target above 6%, it will actually make sure it had this target is achieved. So, and we are looking forward to kind of boost, from the government, say later on. And for the oil markets, we are focusing on the government's policy on independent refiners. Say there have been inspections and independent refiners and some other petrochemical companies since April because of reports of the violation of the country's regulations on the market, say like including tax evasion and the trade of crude oil against the country's laws, and regulations. So the government is now kind of tightening the quotas for independent refiners, but they will kind of hit demand from independent refiners. And now the government is kind of releasing some bulk commodities from its reserves, to depress speculation and to lower the cost for factories, for manufacturers to stabilized growth. Well, that's kind of.
It's a somewhat confusing message out of China because there's obviously they imposed restrictions and fines on certain refineries, and at the same token, trying to curtail off-balance sheet lending and so forth, and yet also trying to stimulate. Vandana, you have put Asia's recovery in the second half of the next 3 months or so forth as you're still slightly positive that they will get there, even though the COVID challenge is present. Just sort of work that out for us, because at the moment it looks to me like Asia might be struggling to be that demand engine in the second half of the year.
Yeah, so at the moment, I think Asia presents a very mixed picture in terms of having gotten COVID under control, in terms of having progressed along its reopening path, and in terms of bringing demand back to normalcy as well. And to just pick up on what Victor was saying earlier, to my mind, the news item, I believe it was yesterday, on Hengli Petrochemical that and published in the government mouthpiece People's Daily, saying that this company, very substantially sized and up and coming refiner and petrochemical producer, had evaded $2 billion in taxes. So, the government is cracking down, as Victor was saying, on the independent refining sector. So I have recalibrated my view of Chinese demand growth. I think it will continue to grow, of course, but I think it's now moderating. The pace of growth is probably coming back more to like 1 to 2%, perhaps, in terms of overall oil consumption growth. And I think as we were discussing, you were discussing earlier on your program yesterday as well, that the crude imports, the era of 8 and 10% year-on-year growth in crude imports has gone as well. But if you look at the overall Asia picture, you tend to focus on, of course, China, India, South Korea, and Japan, which are the major economies. And by and large, while they are certainly not as free of COVID or as ready to completely reopen as the US or even the major European economies, I think they are trekking their way slowly out of it. I think the other advantage that Japan, Korea, and China and India, to a large extent as major emerging economies, have as well, is that they are ramping up vaccinations. So, it's certainly happening.
It's quite slowly. It still seems that it's a fairly slow process.
They're also very large populations, Sean. We have to keep in mind it's a huge landmass to be covered, the very different stratas of society in terms of how well people are connected digitally or not. That is making a big difference as well. So overall, I feel Asia will come out of it, but I think it's interesting. I think the IMF report yesterday encapsulated it very well when it said that vaccine access is actually the new fault line. It's creating two blocks in the world. The vaccinated countries, it expects to continue moving towards normalcy much faster than the unvaccinated world. But within that unvaccinated world, I'm probably a little more positive than perhaps the IMF is when it comes to emerging market economies in Asia. I think they will get there. And until then, as I've mentioned earlier on your shows as well, I think at any rate, the era of stringent, draconian, all-encompassing lockdowns are gone. So, the economic, there is a momentum. It's not as good as what we would have liked to see. But they are emerging out of it. And when it comes to oil demand, once US is back to, it is almost back to 100% of 2019 levels. Once Europe is back, then actually the world will be looking to Asia, because that's where the marginal demand growth comes from.
Matt, if indeed that scenario does evolve, as Vandana said, with the increase in supply from OPEC, 400,000 barrels per day per month over the next 5 months, it doesn't seem like that's enough. Where do you think those two things coexist? Full recovery U.S. economy, Vandana indicating Europe could follow quite soon after. That's a pretty strong demand outlook, and yet we have this pretty tight supply position continuing by OPEC plus.
Look, as I started, I don't. If you look at demand forecast compared to where OPEC plus are bringing back barrels, there is not enough oil. So why hasn't oil popped up to near $100 a barrel? In theory, it should. I look at Brent structure, and look, it's nearly $1 backwardated September, October. Granted, it's the end of the month, so there's people are coming out of their positions. But yeah, it depends if you believe the forecasts. And the whole year has been leveraged off second half demand returning to what it was pre-pandemic. I don't see that. I think that, driving season has been poor in the US. That's always been the bellwether for where demand, for product demand's coming in. Bunker fuel, on the other hand, it's been robust. Ships are still moving. There's been some supply bottlenecks. There's an irony though, Sean. I'm trying to sell a couple of gas oil cargoes at the moment into the US, and the buyer in the US wants the barrels, but he doesn't have the truck drivers available in order to distribute the barrels. So we're in this weird situation where there's enough oil and there's enough demand, but the supply bottlenecks are causing this kind of inflationary argument that we can't get barrels quick enough. American Airlines said the same thing. We had a piece on your digest yesterday that said the same. It's an infrastructure issue. And what that's doing is that's causing Wall Street to translate that into the rhetoric that, well, there's not enough oil. So it's an irony. There is enough.
With inventories falling 4 or 5 million barrels a week, you get eventually, you're moving well below the 5-year average, and you increasingly get into a tighter and tighter market. It is signaling that there isn't enough oil, and yet the market's still not really okay. We recovered from 68 drop during the OPEC crisis and the OPEC fallout, if you like. That came back rather quickly, but there doesn't seem to be a regard for inventories as a momentum number. So even if we get the EIA confirming the API yesterday, it doesn't feel like it is the engine for new levels for oil price.
Well, it's a good point. And, last week there were builds on gasoline and there were builds on crude, the first build for a while, and the market shrugged it off. That was the height of driving season, the kids breaking up from school. You would expect there to be sizable draws. The market shrugged it off. And I think there was a guy quoted on Reuters who said, yeah, the market ignored it last week, still rallied, so that when we see some bullish EIA data, the market will rally again. So you've got to look at the sentiment behind it and the weight of money that's moving into oil. Gold has come off. Is that an inflationary hedge anymore? Maybe it's moved into crude. The Treasury, 10-year Treasuries, they're lower than they have been for a long time. So it's a money thing, Sean, where money is going. And if bearish EIA data during driving season, when everyone has been banging this drum about second half demand being the savior for the oil market, and we see builds on products but draws on crude, well, it means that the barrels aren't really moving. They're being burnt and they're being stored. So this week will be key. If we see the sizable draws that API reported last night through EIA, we could see a pop up above 75. It's trying to break it right now. It just depends on market sentiment, because it's been a bit of an odd one this week.
Victor, we have another story that's percolating in the markets, and that is the US looking at trying to stop Iranian oil moving into China. We're wondering whether that is indeed feasible. Could the US block Iranian exports of oil into China, and what sort of reaction would that be?
Well, I don't think that would be feasible. And just a few days ago, the two sides were met in Tianjin in China, and China made two lists for the United States to do. And actually the Vice Foreign Minister said to Wendy Sherman, the United States does all the evil deeds and it wants all the benefits. Is that reasonable? Well, Chinese government is more than outspoken, I would say. And so this one demonstrates the government's attitude. Unless you do what we think it should be done, otherwise, how could you tell us what to do? So that's the attitude of the Chinese government, the basic. So, and we will be interesting to see what will happen the next 1 to 2 weeks. And say between China and the United States, whether there will be some while some other following measures were to improve the relationship. So we don't know whether the relationship will be improved yet significantly in the near term. Yes.
Vanda, there does on that point. I mean, there is a certain school of thought that says China facilitating Iranian crude oil imports is taking the momentum and urgency out of doing a deal on the nuclear agreement, because we've got this outlet for significant amounts of oil exports, maybe not as much as we would like, but ultimately it takes the urgency. Your thoughts on that thesis and whether the Chinese would react, how they would react to more muscular US intervention on Iranian oil going to China?
So I find this timing of the US declaring its intentions of closing that loophole a little bit interesting. Curious even, because we know that they have had 6 rounds of talks, very well-intentioned on the nuclear deal with Iran. And we know that since then, it's all gone quiet. So there is a 7th round planned, but I suppose they're waiting for Ibrahim Raisi to get sworn in on the 5th of August, and then perhaps test the waters as to what he says, what stance he takes. So far, he has indications are that he's taking a bit of a hardline stance. He's said soon after his election that Iran's missile development programs and its regional activities are going to be off the table. So could it be that the US, it's a little bit of a saber rattling going on from Washington, ahead of perhaps expecting to get back at the table with the Raisi administration? That's possible. Look, this export to China and a few other countries, but most of it to China of Iranian oil has been happening for several months now. And the US, despite its earlier declared policy of completely stamping out Iranian exports, it never really went the whole hog.
No.
And as Victor mentions, also, first of all, it's going to be difficult to catch it because, as we know, we've been talking about this on your show as well. It's very, very under the radar. I think China may even get away on a bit of a technicality, because I've also heard that these barrels are actually being stored in the bonded storages, and maybe Victor knows more about this. So technically, they have not really been imported into China. So there's all these kind of things. But
I think also. So go ahead.
I think this could just be a negotiation tool, to kind of set the stage for perhaps slightly tougher talks with the Raisi administration.
Okay, let's get the survey question, because that's what I just pointed at this morning as to what people's view is on this effort, that if indeed the US were to really initiate it. Will the US succeed in stopping China from buying Iranian crude oil that is currently under sanctions by the US? A question to the room. Let's move a little bit forward, Matt, thinking about the week ahead, the week or days ahead, and particularly today. We referenced it earlier. The Fed are meeting, the Fed commentary coming out. Your thoughts, is the Fed a market moving issue these days, or is it sort of lulled everybody to sleep with there's no inflation to look at here? What are your thoughts? What are you looking at from the Fed?
I think if there's a change in rhetoric about them saying that inflationary is purely transitory, then I think the markets will react, especially foreign exchange. I think the dollar will come off on that news. It's largely, if we translate the Fed to what happens in the oil market, we can always say, okay, a weaker dollar means that's good for oil prices, et cetera, et cetera. But ultimately, the market is not looking at the fundamentals. And Russ Edwards said this to you a while ago. The rally is a financially driven one. It's not one based on oil market fundamentals. When OPEC came out last week and said that they're going to raise production by 400,000 barrels a day, it looked through it and it collapsed by, obviously, we saw a sort of 6% drop. I was sipping a Mai Tai at the time. I hope you don't mind. But I was keeping up to date with it on my phone. And then there was no other news that came out, and the market rose back up to levels when the fundamentals remained exactly the same. So it's money flow, Sean, and any bullish news will be jumped on immediately and pounced on. It will be interesting to see what happens. But there's a couple of stories that have interested me this week. One closer to home here was Lebanon. Obviously, they've got a new prime minister, and the Iraqi deal that they've concluded on some fuel oil supply for their energy use. So there's seems a lot more cohesion that's going on within the Middle East at the moment. The geopolitical news seems to be positive as opposed to negative. I know the US and Iran is still an issue on the sidelines, continue to be there. North Korea, South Korea getting together. So there certainly seems to be a lot more cohesion. And the longer that continues, and everyone and Wall Street thinks that we're all dancing around a campfire, toasting marshmallows, then it could be $80 a barrel before you get all your first ice cream.
But I don't know if you can have all of those things and the Fed staying on the sidelines, because if it were all marshmallows, then the Fed were forced to move. Victor, coming out of the refinery maintenance season in China in the sort of second quarter, we would expect utilization rates to rise. They're still quite low in the low 80 percentile. What's your outlook for refinery utilization numbers in China rising through the end of the third quarter?
Well, the run rates at state-run refineries had actually rebounded modestly, but not as significantly as well before. And one reason is because, well, the government is now tightening the quotas for oil product exports, well, say gasoline, diesel, and jet fuel. And they had to slash exports from July on because, well, the country has not issued the second batch of quotas for exports yet, and they're now running short on quotas. Well, so the state runs will not rebound much further for state-run refineries, and for independent refineries, well, they have actually dropped because, well, at least 2 refiners have been shut because of the inspections by the government. And last week, the run rates dropped by over 4 percentage points were in Shandong, just because another refiner was shut. And so the run rates at independent refiners would drop. I mean, would not rebound. I mean, at least not rebound much in the rest of the year, the third quarter, because of the government's is tightening the control and regulation on them. And so basically, we expect the run rates in the third quarter to kind of level out at least one.
Let's get the survey result and give Vanda the last word this morning. Oh, that's a big, that's with a couple of exclamation points. Vandana, on the point of the weak dollar that Matt referenced, you have it also in your Bulls and Bears report, seeing it dollar strength as mildly bearish. The outlook for that, do you think, where does it go to influence the market?
Yeah, so let me quickly talk about the dollar and some of the big picture story as I see it for the oil markets over the next 3 to 6 months. So the dollar has been dancing around 93 handle for the ICE US dollar index. I think it has been doing so for long enough for crude to have baked that in, which is why I call that mildly bearish. Also, I don't think it's going to continue spiking much more from here, which is another reason, I don't think that's in itself is going to exert a major bearish pressure on crude prices. But going forward, I think supply for a change is, I think we have relative certainty. The oil markets have relative certainty on that. I think looking back, OPEC Plus is probably going to say that 400,000 at the time, it seemed bullish, it seemed overcautious, but now looking back, probably seems like a good move. It's like probably might be just about right. And of course, they'll be meeting every month, and they can, if they think that there is ever a danger of the market tilting to an oversupply, I think they wouldn't hesitate for a minute to just call a halt or pull it back. So I think relative certainty on supply, I think that is constructive to bullish for the oil market. I think demand is now a major variable, especially because of the Delta variant, and of course all other or any and all other variants that unfortunately might be rolling out after that. And the other problem, I think the challenge for the oil markets now is that whatever correlation we had evolved through last year, that this is this many number of cases in this country, and this the steps the government takes, the correlation between cases, hospitalizations, deaths, and the government response. I think all those correlations are now completely broken down, primarily because of vaccination. We see highly vaccinated countries responding to outbreaks and resurgence very differently from lower poor vaccinated countries. So I think the demand question is going to be the big challenge, but I think OPEC will make sure that it remains highly responsive on the supply side. So I don't see a major downside either.
Well, I think the good thing in OPEC Plus's favor ultimately is that you're really only talking about 4 or 5 countries at this stage that actually have the ability to add more supply. And so it's not trying to corral 20-something countries. It's really just a handful. I think it's also worth noting today, keep an eye on the Fed commentary on the issue of, is this a rebound or a recovery? If they continue to keep saying it's a rebound and they're not going to do anything, then that, I think, at some point becomes a bearish statement, because ultimately it's saying this is not a healthy economy, so don't bet on it. And once they start saying it's a recovery and they start taking action, then that might actually be bullish, because it gives more confidence to the longer term sustainability of the economic activity we're currently seeing, which in the US at least, quite buoyant. We have a good interview today with Dr. Anas Al-Haji, familiar to most, I would imagine. Dr. Anas was very keen to point out that at the Energy and Environment meeting last weekend, oil had a big win because it forced coal to the front as being the bad guy, and oil got to move to the back of the theater. And now China and India have to fight for coal against the carbon challenge, whether it was oil. I thought it was an interesting insight he had on that meeting. So when you have 20 or 30 minutes, that might be worth a listen to. Thanks, Vandana in Singapore, Matt in Dubai, Victor in China. Really appreciate your comments this morning, and we'll catch up with you tomorrow, same time. All the best. Have a good day.
You too.